Sanju Verma is joining us right now. She's CEO of Violet Arc Global Managers. She's also spokesperson of the BJP in Mumbai. Sanju, thanks very much for your time. Good to have you here. A lot lower than from the last time that we spoke, Sanju. How much lower you think?
Prashant, a lot has changed since the last time you and me, interacted. I think the basic problem, to sound very cliched, but nonetheless, this is the harsh truth, and we might as well face up to it. I've been tweeting about it quite rigorously for anyone who cares to notice. Global risk aversion has been there, and this has been the case not just in the last fortnight or so, when the telltale signs of a bear hug were clearly visible. The first signs of trouble brewing in global markets came on the 15th of January this year, a little less than a month back, when Nicolas Maduro, the Venezuelan premier, clearly said that a Venezuelan default is on the cards. And mind you, they have an external debt of $185 billion, which is far more than the Argentinian default of 2001, when Argentina had a sovereign default of just about $100 billion, but the ramifications, thanks to the multiplier effect, were humongous. That told me then that something was amiss. And my colleague was there on your channel a few days back, and he clearly called out for 6,800 or even lower. So as a house, I think we clearly called out the impending bear hug. My personal sense is that this is not about Indian equities. This is not about equities per se either. This is more about a flight to safety, be it equities, bonds, crude, base metals, everything got slaughtered in the last 3 or 4 trading sessions, particularly yesterday, barring gold, which was the only, tall one standing out. So I think until the global risk aversion wave dissipates, for people to come back into equities as an asset class, I think that will be, something that we will have to watch out for. As I've always, maintained, markets, no matter what you and me say, it's very easy to say, greed is good, and, buy when there's panic all around and sell when there is euphoria, all around. It's very nice to mouth these, homilies and expletives. But the fact of the matter is that when you have stocks crashing by 50-60% in 2 days, the sentiment gets unnerved so brutally that it takes a while for the retail investor who's burnt his or her fingers to get back into the markets. And mind you, in the last 1 year, in 2015, it was not FIs, but domestics which were relentlessly buying and, cushioning the market from any adversarial global headwinds. So my sense is that globally, a couple of things need to be in place. We need to get greater clarity from Janet Yellen. I think she spooked the markets day before yesterday by calling out for negative interest rates. I think that one statement did more damage to global sentiment in the last 48 hours than the interest rate hike of 25 basis points that she, undertook in December of 2015. Don't forget that negative interest rates can be, extremely harmful in a condition where the global economy sees a lot of slack. Balance sheets of many banks are still getting purged. You and me are well aware that credit growth, offtake, has been slowing for many of the peripheral economies in Europe and elsewhere in many parts of the Western world as well. So I fail to fathom what is it that made her make that very irresponsible statement of saying that negative interest rates, are something that are not off the table. So my sense is we need, more clarity. The only good thing, the only silver lining, given the optimist bull that I've always been, is the fact that, my sense is for the next 3 to 4 months, I do not see an interest rate hike from the US. Not because the, payroll numbers for last month were pretty much abysmal, with the US adding only 151,000 jobs. I think the greater worry is that, a large part of the US believes that US is already in a recession. Because don't forget, Prashant, technically a recession is when you have 2 consecutive quarters of a decelerating GDP. So for the December 2015, US annualized GDP came in at 0.7%. And for the September quarter, it was 2%. And mind you, for the June quarter of 2015, it was a hefty 3.9%. So from 3.9% in June of 2015 to 0.7% in December 2015, and now we are talking of actually a negative GDP growth in the US for the March 2016 quarter. So what a fall from grace. So I think technically, going by the pure technical definition of what economics has to say about recession, US is already in trouble. I think the S&P 500 earnings will recover, and how, in 2017. But this year, more than 40% of S&P 500 is reported. And forget about, the likes of, Halliburton, Schlumberger, British Petroleum, Concast. Look at even a Microsoft and an IBM. They've reported revenue declines of anywhere between 8.5% to 10%, which is very, very steep. So my sense is that all these global factors put together, not to mention the fact that, Janet Yellen has given a whale reference 48 hours back to maybe trouble brewing, when new stress tests are conducted on some of the European banks. We've already seen Deutsche Bank falling 30% calendar year to date. Credit Suisse, I believe, is writing back goodwill impairments, which may cost them dearly. So I think there are a lot of moving parts to the global risk aversion equation that needs to be digested. It's not easy to understand. To, simplify it for your viewers, is a bigger fall likely? Will it stop here, or is this it? Well, it's very, very difficult to call out short-term trends. I'm not a technical analyst. I believe that fundamentals play out in the longer run. That said, my personal sense is that at 60 to 6,300, maybe the damage would be more or less done out of the way. And the reason I say this is because I still believe, and for good reason, that in the next 2 quarters, the way Indian PSU bank balance sheets are getting clean and purged out. In the interim, there is a lot of pain, but I think 2 quarters down the line, we will have a lot to be more assured of. Because don't forget that most banks, be it an SBI, an OBC, a Bank of India, or even, sorry?
You said, I missed the number. You said 63. You expect to see the market going to about 6,300, and then that you think, or you said 6,800. I couldn't hear the number.
I said this range of between 6,300 to 6,800 is where the markets will, sort of trade in the interim, because there is still 1 more quarter of pain left with respect to the earnings of public sector banks in India. Because don't forget that after the stringent asset quality review and provisioning norms that kicked in a year back, and the impact of that is being felt only now, most banks have already provided for about 50 to 60% of stressed assets on their book. So 30 to 40% of, the bad loans which are on the book have still to be provided or provided for with respect to the new asset quality review norms. So once that is done, which will take another 3 to 6 months, which means 1 or 2 quarters more, the pain with respect to the Bank Nifty will subside considerably. And given that Bank Nifty accounts for 33% odd of the broader indices, particularly Nifty, I think if the Bank Nifty holds steady, you will have, a lot of this mayhem being taken care of. So the reason why I say we will go down to 60 to 6,300 is because I believe that the worst is still not over. Look at, for example, a Punjab National Bank. Even after the mayhem, people said that, maybe 60 rupees is a good place to get into the stock at. 70 rupees looks good, because look where it has come down from. But my simple point is that the book value of Punjab National Bank today is just about 35 odd rupees. This used to be one of the 2nd or 3rd largest banks in India. And look at it today. The market cap is less than 30,000 crores. The market cap, I'm told, is actually less than 20,000 crores. It's barely 17 or 18,000 crores, maybe less. And, they've added slippages of something like 30,000 crores. So this kind of a problem is not going to vanish overnight. You know, it will take a while for public sector banks to get into their own. Hence, 3 to 6 months is what is the period of pain that I'm looking at before there is a semblance of sanity and markets start looking up. But I mean, we all know everything that, go up like a rocket and down like a stick. We were there at 9,100 plus a couple of months back. We were all, including me, we were saying that perhaps 10,000 or 11,000 before there's a correction, but markets chose to defy us, and how. And now, I'm not one of those who believes that the markets will crash all the way to 5,000 or 4,500, because I've seen naysayers and doomsayers predicting doom and gloom. I don't belong to that camp. I think 62, 6,300 is where you should start aggressively getting into the markets and not just nitpicking.
No,
if you really have a 2-year horizon, it sounds cliched, but let's not forget equities is the only asset class to have given you 5x in 10 years.
Yeah. Yeah. No, I was just saying that you should say that everyone except yours truly was not in the when market was at 9,000. I wasn't saying that we should. I mean, we've sparred on this many a times, right, over the last 1.5 years. But anyway, I'm not looking to Tom here. But you began by saying that the cliched things like market, you should sell when people are greedy and buy when there is fear, and it is difficult to do. These are cliched things, but the fact is that is how you make money. The reason few people do it is because it's extremely hard to do. That's why you only have very few very successful people in the market. Majority of the people fail to make any wealth over a period of time, because it's very, very hard to do. But that doesn't make it wrong. That's the point I was making. I mean, that cliched line isn't wrong because it is hard to do.
Absolutely.
That's the point. Yeah.
No, Prashant. In fact, on there, I'm not going to spar with you. I am with you on that one. For a change, we converge on that. I think you need to realize that, the earnings growth, for the December quarter, while there have been misses, I think a lot of big companies, I'm not talking of small caps or mid caps, I fail to understand why nobody seems to be acknowledging the fact that a Britannia posted a 51% growth in net profit. Their rural sales growth came in at a whopping 35%. Look at Ashok Leyland, which I think is a proxy to the recovery not only in the heavy and commercial vehicle cycle, but in the broader economy as well. I mean, a 6 times jump in bottom line, a 79% growth in EBITDA, I think that's as good as it gets. Even Tata Motors, for that matter, while the standalone figure came in at a loss of 201 crores, the fact of the matter is that most analysts were talking of a loss in excess of 400 crores. So to that extent, they bettered the market. Even a Gujarat Ambuja, I think the results were pretty decent. While the volume growth was tepid, we are talking of easily a 7 to 8% volume growth in the next financial year. Look at an Aurobindo Pharma. While the whole market has been dissing about Dr. Reddy's, and maybe rightfully so, barring the fact that the stock was up yesterday on the back of buyback news, the fact of the matter is that Aurobindo reported a net profit growth of 39%. So these are, earnings that have chosen to surprise on the upside. In fact, even a Bank of Maharashtra, I'm surprised simply no analyst in the market seems to have acknowledged the fact that it reported a 56% jump in profits. Apollo Tyres, which rose 11% after results were announced, because again, this was a company that reported a 51% jump in bottom line. So I think there have been companies that have reported great set of numbers, but the markets being what they are, as they say, when you are in a bear hug, even if it is temporary and transient, any good news is bad news. And the converse is true in a bull market as well, as we all know. At the peak of a bull market, people justify valuations of 7 times and 8 times price to book on the market, and, a PE of 25, 26 times. If the market trades at 62 or 6,300, that would be just 12 or 13 times 1 year forward, assuming that the earnings growth in FY17 is barely going to be 12 to 15%. I mean, I would try to nibble into the market at that point aggressively, because historically, though, historical data counts for little, historically, Indian markets in the last, 10 to 15 years have seen a mean PE of nothing less than 15 to 16 times. So I think if you look at valuations, if you look at earnings, where the recovery has been slow, but surely it's gaining traction. These are factors that I derive comfort from. Also, I think people say, oh, nothing much is happening to the economy on the ground. I think that's a hugely misleading fact. Because
You know,
I think
Sanju,
the fact remains that the seventh pay commission...
We can spar on that at a later time. And I'm out of time. Thank you very much for coming in. And I must say that your technical analyst has been very prescient with his calls. So do pass on that to him. Thank you very much for coming on.
Yes, I think, Mithil has been amazing with his calls on that. Thank you. Thank you.